Right now, somewhere in Canada, a family is making a $272,000 mistake. They don't know it. Their bank hasn't told them. And by the time they find out, if they ever do, it will be too late to get that money back. That family might be you. If you have money invested in a mutual fund at a Canadian bank, RBC, TD, BMO, Scotiabank, CIBC, I need you to stay with me for the next 8 minutes because what I'm about to show you is the single most important piece of financial information most Canadian families never get told. And it comes down to one number on your investment statement that almost nobody looks at. That number is called the MER, the Management Expense Ratio. It's the annual fee your fund charges just to exist. Most Canadian bank mutual funds charge between 1.5 and 2.5% per year. The average is around 2.2%. That sounds small. It isn't. Here's what 2.2% actually costs a family investing $500 per month from age 32 to age 62. Pull out a calculator if you want to follow along. At a gross return of 7% before fees, that family ends up with approximately $864,000. Now take the exact same family. Same $500 per month, same age, same 7% gross return. But instead of a 2.2% fee mutual fund, they're in a low-cost index ETF with a fee of 0.20%. That family ends up with over $1.1 million. The difference is $272,000. Not because one family invested more, not because one took bigger risks, just because of the fee. That's it. That's the whole story. And in the next few minutes, I'm going to show you exactly how this happens, which specific funds are costing Canadian families the most, and what you can switch to this weekend if you want to be the family with $1.1 million instead of $864,000. If you're new here, this is Minivan Millionaire Plan. We help everyday Canadian families build real wealth without the hype. Hit subscribe right now because this is exactly the kind of content we cover here. And there's a lot more coming that I think you're going to find useful. Now, let me show you how this plays out in real life. Because the numbers are one thing. But seeing it happen to a real family makes it impossible to ignore. Meet the Martins and the Chens, two families living in the same city, both 32 years old, both with household incomes of around $90,000, both with $500 per month to invest, both starting on the exact same day. The Martins do what most Canadian families do. They walk into their bank, sit down with an advisor, and say they want to start investing for retirement. The advisor is friendly and helpful. They set up a mutual fund inside the Martins RRSP. It's a balanced growth fund. Sounds good. Feels responsible. The MER is 2.2%. The advisor doesn't mention the fee. The Martins don't ask. They leave feeling good about their decision. The Chens do something slightly different. Before going to the bank, Mr. Chen spends a Sunday afternoon going down a rabbit hole online. He reads about index funds. He opens a self-directed account at a discount brokerage. He buys XEQT, a single all-in-one index ETF that holds thousands of stocks across Canada, the US, and international markets. The MER is 0.20%. He sets up an automatic contribution of $500 per month and forgets about it. Same $500 per month, same starting age, same market returns. Two completely different outcomes already in motion. Here's what's actually happening inside these two investments and why the fee difference matters so much more than it looks. The Martins Mutual Fund is actively managed. A team of professional fund managers is making decisions every day about which stocks to buy and sell, trying to beat the market. That expertise costs money. That's where the 2.2% fee goes. Every single year, 2.2% of everything the Martins have invested gets paid to the fund company, not just on their new contributions, on their entire growing balance. The Chens Index ETF does something completely different. Instead of trying to beat the market, it simply owns the market. XEQT holds over 9,000 companies across dozens of countries. When the global economy grows, the Chens grow with it. There are no fund managers making active decisions. The cost of running the fund is almost nothing, which is why the fee is only 0.20%. Now, here's the critical question. Does the Martins actively managed fund make up for its higher fee by delivering better returns? The research on this is overwhelming and consistent. Over long periods of time, 10 years, 20 years, 30 years, the vast majority of actively managed mutual funds underperform simple index funds after fees are taken into account. Not because the fund managers are bad at their jobs, but because fees compound just like returns do. And a 2% annual drag on your portfolio is almost impossible to overcome consistently over decades. The Martins aren't just paying more, they're almost certainly getting less. Both families invest $500 per month from age 32, $7,000 into their TFSA first, then remaining contributions into their RRSP. Both earn a gross return of 7% per year before fees. The only difference is the fee on their investments. After 10 years, the Martins have approximately $78,000. The Chens have approximately $84,000, a $6,000 gap. Noticeable, but not alarming. The Martins have no idea anything is wrong. After 20 years, the Martins have approximately $185,000. The Chens have approximately $220,000. The gap has grown to $35,000. Now it's starting to sting, but the Martins still don't know it's happening. After 30 years, when both families are 62 and thinking seriously about retirement, the Martins have approximately $864,000. The Chens have approximately $1,136,000. The gap is $272,000. $272,000 gone, not lost in a market crash, not spent on anything enjoyable, just quietly paid in fees over 30 years to a fund company that delivered worse results than a simple index fund tracking the same market. That $272,000 is roughly 3 years of household income for a typical Canadian family. It's 2 kids' university educations fully paid. Is the difference between retiring comfortably at 62 or working 5 more years. And the Martins never saw it leave. That's the cruelest part of this story. The fee never showed up as a line item. It just quietly eroded their balance every single year while they assumed everything was fine because their balance was going up. Your balance going up does not mean your fee isn't costing you a fortune. Those are 2 completely separate things. Now, here's the part that matters most for you watching this right now. The Martins are not a cautionary tale about bad people making dumb decisions. They're a completely normal Canadian family who did exactly what most people do. They trusted their bank, they didn't ask about fees, and they assumed the person across the desk was optimizing for their retirement. Most Canadian families are the Martins right now. If you have a mutual fund at a Canadian bank, there is a very high probability you are paying between 1.5 and 2.5% per year in fees without fully understanding what that costs you over time. The first thing I want you to do after this video is look up the MER on your fund. You can find it on your statement in your online banking or by Googling your fund name followed by MER. Write the number down. If it's above 1%, keep reading. So what do the Chens actually own? Let me make this as concrete as possible because I want you to be able to act on this today if you choose to. XEQT is an iShares all-in-one ETF available at any Canadian discount brokerage. For 0.20% per year, it gives you exposure to over 9,000 companies across Canada, the United States, international developed markets, and emerging markets. It automatically rebalances. You don't need to do anything after you buy it except keep contributing. It works inside your TFSA and your RRSP. VEQT is Vanguard's equivalent. Also all in one, also globally diversified MER of 0.24%. Both XEQT and VEQT are excellent choices. Both are available at discount brokerages like Questrade and Wealthsimple, two of the most popular platforms for Canadian families starting out. If you want slightly more conservative, meaning a small allocation to bonds to reduce volatility, XGRO and VGRO are the growth versions with roughly 80% stocks and 20% bonds. Still extremely low cost, still dramatically better value than a typical bank mutual fund. And again, all of these work inside both your TFSA and your RRSP. These are not obscure investments. These are the funds that informed Canadian investors, teachers, nurses, engineers, accountants quietly use to build wealth while the average Canadian pays 2% at their bank branch without realizing the cost. I want to be clear about something important before we go further. I am not a licensed financial advisor, and this video is not personalized investment advice. Every family situation is different, and before making any changes to your investments, it is worth doing your own research. If you need personalized guidance, look for a fee-only financial advisor, someone who charges a flat fee for their time rather than earning a commission on what they sell you. That distinction matters enormously. What I am doing is showing you the math, and the math is not ambiguous. So what does switching actually look like if you're currently sitting in a bank mutual fund? Step 1, find out what you own. Look up your fund name and MER. Write it down. Step 2, open a self-directed TFSA and RRSP at a discount brokerage. Questrade and Wealthsimple are the two most popular options for Canadian families. Both are free to open. Questrade charges no commission to buy ETFs. Wealthsimple charges no commission on any trade. Step 3, prioritize your TFSA first. Max your $7,000 annual contribution before directing money into your RRSP. If you have unused TFSA room from previous years, you can contribute more than $7,000 this year to catch up. Step 4, before transferring any existing investments, understand the process. Moving money between registered accounts is done as a direct transfer and does not trigger taxes. Your new brokerage will walk you through it. It typically takes 1 to 2 weeks. Step 5, choose your fund. XEQT or VEQT for all equity. XGRO or VGRO if you want a small bond allocation. Set up your automatic monthly contribution. Walk away. Step 6, leave it alone. This is genuinely the hardest part. index investing only works if you stay invested through market ups and downs. The families who build real wealth are not the ones who time the market. They are the ones who stay in the market consistently for decades. This is Minivan Millionaire Plan, built for Canadian families who want to build real wealth on a real income without a finance degree. Subscribe if you haven't already. Drop a comment below. Are you currently in a mutual fund, or have you already made the switch to index ETFs? And are you maxing your TFSA before your RRSP? I want to know where you're at. I read every single comment. See you in the next one.